HDFC, India's biggest mortgage lender, reported a 17% rise in its net profit for the fourth quarter, helped by a higher loan disbursal. The standalone net profit for the fiscal in the fourth quarter came in at 1,555 crore rupees as against 1,326 crores in the same period last year. Joining in for more on the numbers is Keki Mistry, the Vice Chairman and CEO at HDFC. Thanks very much for joining in, Mr. Mistry. To start off with, if you could just take us through your fourth quarter standalone profits and net interest income growth and how that has shaped up.
I would say that the biggest contributor to growth in the current year has been the huge demand for individual housing loans. And if you add back the loans we sold in the last 12 months, then the growth in the individual loan book at the end of the year was as high as 31%. Now this is much higher than what normally we talk to investors on. We always talk of a growth of around 18 to 20%, but this year the growth has been extremely high or extremely strong at 31%. We also hope that with the additional tax benefit that has now been provided on housing loans, which would be applicable if a customer takes a loan before 31st March 2014. Keeping that in mind, we would hope that the demand for housing loans will continue to remain strong over the next couple of years. As far as the profits grow, the profit growth for the year on a post-tax basis has been typically 17% for the quarter and 18% for the year. Our profit for the quarter was 1,555 crores post-tax, and for the year was 4,848 crores post-tax. Spreads marginally went up. Our spreads last year stood at 2.27%, and in the current year spreads stand at 2.30%. So there's a 3 basis points improvement in spreads. Individual spreads stood at 1.96% in March compared to 1.95% in December, whereas non-individual spreads stood at 2.94% in March compared to a slightly lower number in the previous year. So that is as far as spreads go. As far as net interest income goes, net interest income for the year stood at 4.21%. In December, this number had stood at 4.1%. Last year, this number had been 4.35%.
Mr. Mistry, will you be looking at growing your individual loan book further in FY14, or are you going to focus on the individual portfolio as well? And also, can you tell us where a chunk of your loan growth this time around has come from?
Having a young population, what it means is that people will buy a house as they move into their mid-30s. The average age of a customer at the time he takes a loan from HDFC typically is between 35 years and 37, between 35 and 37 years. And with so many Indians today being below 30 years of age, all these people will in the next 1, 3, 5, 7 years need housing and therefore housing loans. So we would continue to believe that the growth over a sustained 5-7 year period will remain strong.
And apart from that, can you give us a sense of how your asset quality, both individual and non-individual portfolio, has shaped up? And do you think we can expect the asset quality to keep improving going forward?
Well, I can't make, again, forward-looking statements on whether we can expect more. I would hope so. We have seen the 33rd consecutive quarter in March 2013 where the level of non-performing loans was lower than what it was in the previous year at that time. The decline is marginal. There's a 4 basis points decline in gross non-performing loans compared to the previous year. In March 2013, non-performing loans stood at 70 basis points, 0.70%, compared to 0.74% in the previous year. If we break down that 0.70% between individuals and non-individuals, individual non-performing loans stand at 58 basis points, non-individual non-performing loans stand at 91 basis points.
And finally, has your cost of funds come down of late? Is there any scope for a rate cut from you?
See, we monitor the cost of funds very, very closely. Whenever we feel that there is a reduction in cost of funds, which will give us the ability to cut our lending rates, we will certainly do that. We have cut our base rate marginally sometime in February, which was in response to a reduction in cost of funds. So if we were to see more of that happening in the course of the year, of course we will do that.
Mr. Mistry, we'll leave it at that. Thanks very much for joining in and giving us a greater in-depth perspective on your numbers and the growth going forward.